Mr. and Mrs. Griffin. I really appreciate you coming in today. Also appreciate you sending me in all the financial information as well as filling out the questionnaires and surveys that I needed in order to be able to make recommendations for you. So first I'd like to start off by reviewing the information you sent in to make sure it's accurate. I've got John and Jackie Griffin. Both of you are age 37 and you two are married. You've got 3 children, Jack, who is age 6, Jill, who's age 3, and Jane, who is age 1. The household income is $85,000, and John earns that income currently. Your net worth is $244,861, and neither of you are self-employed. I understand that you two have identified a budgeting issue. You understand that you spend too much of your monthly income and you'd like to reduce your debt. You also have 3 children that you want to provide child care for during their school age years, and you would also like to provide 4 years tuition for each child for their post-secondary education. To date, you haven't saved any of the money for their college education, and you'd like to understand what needs to be saved so that you can begin saving. You also would like to retire at age 62, living on 70% of your pre-retirement income. You expect to live for 29 years in your retirement, and you understand that you'll need an appropriate risk management portfolio, investment portfolio, and estate planning portfolio to meet your goals. So I did make a few assumptions in order to be able to come up with recommendations for you all. An adequate emergency ratio for your family is 3.5. This actually represents the number of months of coverage by cash and cash equivalents for your non-discretionary cash flows. We will go over what non-discretionary means, what your cash and cash equivalents means, but essentially this is just what will cover you in the event that your husband is no longer able to work and you all have to live off of your savings to pay for your basic living expenses. Also, an appropriate current ratio for your family is between 1 and 2. So you want to be able to meet your annual expenses at least 1 time, possibly 2. That's the best scenario. An appropriate housing 1 ratio is less than or equal to 28%. That means that you all are spending your monthly income, well, no more than 28% of your monthly income on your housing expenses, and a housing 2 ratio is less than or equal to 36%. So that includes your basic housing expenses as well as all of your other debt payments. You want to keep that below 36%. For your retirement benchmarks, you all want to retire at age 62. You want to maintain 70% of your pre-retirement income, as we've discussed before. You plan to live for 29 years in retirement. The inflation rate is 3%. Your income tax rate is 15%. You expect your investment returns to be 8.5%, and your risk tolerance is moderate according to how you all filled out the survey for your risk tolerance. For your college education goals for your children, the education inflation rate is assumed to be 6%, and the current annual cost for education is $17,000 per year. After reviewing your risk management documents, which includes your insurance, I have a few things that I'd like to mention to you. Mr. Griffin, you do have a life insurance policy, and that's great. I'm glad that you did start that. The limit is not adequate to cover your family's needs at this time. The life insurance policy should have a face value of at least 12 times your annual salary. In that way, in the event of your death, your family will be covered for the expenses that they come across. Currently, your policy limit is $25,000. So I'm recommending an increase of that policy to at least $1,020,000. That would be 12 times your salary of $85,000. I would also consider getting a life insurance policy for Mrs. Griffin to offset the cost of child care that the family would incur if she were to pass away. Although you don't work, Mrs. Griffin, your contributions to the household should be protected as well. Mr. Griffin, you should have a disability policy that covers you if you become sick or you get into an accident or you become injured. You do have a policy currently that covers 52% of your gross pay. I think that it should be increased slightly, just increased by $550 a month. So that's a slight increase in the cost of the disability insurance policy, only $16.44 per year, but it would provide you all additional income in the event that you are unable to work, Mr. Griffin. Your policy should have an own occupation definition because that only requires that you're unable to perform the material and substantial duties of your occupation to be considered totally disabled. The any occupation definition would demand that you are unable to complete the important functions of any occupation, and so that offers far less coverage than the own occupation definition. Both of you should consider long-term care policy, a long-term care policy in the case that you are injured or have an accident that requires long-term care. I would actually recommend that you hold off on purchasing a policy until age 45. There is a chance that you would become injured before then, but I wouldn't recommend purchasing the policy until you turn age 45. Mr. Griffin, your employer, does offer a health insurance policy, and it covers the family with an unlimited lifetime benefit at a cost of $1,200 per year. This is adequate coverage, so I don't recommend any changes since the lifetime benefit is greater than or equal to $1 million. So now we've reached your homeowner's policy. The homeowner's policy dwelling limit is actually lower than what I would recommend. Currently, your policy only covers 67% of the market value of your home. I would recommend that this policy covers at least 80% of the market value of your home. So there will be a slight increase there. Your auto policy has inadequate liability coverage. You're currently covering yourselves at the state minimum for liability. Liability covers you in the event you cause an accident with someone and you injure them or you damage their property. For homeowners, we typically recommend limits of $100,000 per person, $300,000 per accident, and $100,000 for any property you may damage. Currently, your policy is $10,000 per person, $20,000 per accident, and $10,000 in property damage. I would also recommend that you all purchase a personal liability policy with a limit of $1 million. That policy would have an additional premium of $250 per year, but it does cover you for both your auto and homeowners insurance policies in case you are found liable and someone does sue you. So this protects your assets, and you all are going to work very hard to accumulate your assets, so you certainly would want to protect them. All right, and you all own the ATV and it's currently uninsured. If you do decide to keep that ATV, we definitely would want you to get a special lines policy for it to cover it. If you decide to sell it, you don't need the policy, but in the interim between the time that you sell the ATV and now, you should have a special lines policy. All right. So now we're going to cover your debt management and short-term obligations. So I've actually taken the ratio approach in order to measure how you all are doing on your debt. The first ratio is the emergency fund ratio that we sort of discussed earlier. Currently, your emergency fund ratio is 1.72, meaning that you all have enough cash to pay for your expenses for 1.72 months, almost 2 months, should you be without income. This is below the recommended amount of 3 to 6 months. At a minimum, I'd like to see you all at 3 months, but ultimately we like to see you with 6 months of cash available in order to pay for your expenses if this were to happen. This emergency fund ratio is extremely important because it measures how much time you all could survive and pay your most important bills with your liquid cash. So your non-discretionary cash flows, I mentioned this earlier, this includes things like your mortgage loan, your insurance, your taxes, food, utilities, clothing, these most important things. So in order to get this ratio in line, we will be finding some savings to your non-discretionary expenses, but also we want to consider increasing your insurance deductibles to lower the premium on those policies, and that could create an additional cash flow to save towards your emergency fund. In the meantime, though, you all do have a home equity line of credit, so if an emergency were to occur, you could tap into that line of credit. But keep in mind, though, that that does apply to your primary residence, so that is a worst case scenario, last resort account to use. So the second ratio is the current ratio. your current ratio should be somewhere between 1.0 and 2.0. You all are at 0.39. This ratio represents the amount of times that you can pay your current liabilities with the cash equivalents that you have. So current liabilities are those that are due within the next 12 months. You don't have enough cash to pay your current liabilities even once. So we will certainly want to get you in a position where you have enough cash to be able to pay your expenses that are due within the next year at least one time. Your housing one ratio should be in a range of less than or equal to 28%. Currently you all are at 33.6%. This ratio represents the percentage of gross income used for paying your basic housing, which includes your things like your mortgage payment, interest, homeowners insurance, and property taxes. So we will want to get this down to below 28%. One method of getting this ratio below the 28% would be to refinance your primary mortgage. You all are at a higher interest rate and there are lower rates available to you. There's a 4.0 rate available for a 30-year fixed mortgage. I would recommend that you all take advantage of that lower rate, which would actually lower your payment and free up some extra cash, about $6,600, but we'll discuss that a little bit more later. Your housing to ratio should be below 36%, and it's actually at 64.9%. This ratio, it represents your basic housing costs, including other things like your automobile loans, your bank loans, credit card payments, and other debt payments that are made on a recurring basis. Getting your housing one ratio in line will of course help out with your housing ratio two, but we certainly would need to reduce those recurring other debt payments in order to get this ratio down. Starting off with your highest interest, meaning your credit card payments, your unsecured bank loans, and then working our way down to your automobile loans and other debt payments. If you follow the recommendations that I have for your liquidity and debt ratios, you will be within the recommended limits within 3 years. By increasing your cash and cash equivalents to $40,900, your emergency fund ratio will be 9.04, making everything above 6.0 available to retire bad debt, which includes your credit cards and unsecured loans. Your current ratio will be 1.35, still not at the optimal level, but within a reasonable limit. Your housing ratio 1 will be 27.7%, just below the threshold, and your housing 2 ratio will be 39.4%, not quite below the threshold, but it is a lot lower than 64.9%, and the excess cash and cash equivalents that you'll have from saving can be used to pay off those additional debt payments and bring you within that limit within 5 years. Alright, so now let's talk about education, which is one of your major goals for your children. Today you haven't put aside any money towards your children's college education, and that's a major drawback because you know that ultimately you have to pay for their tuition. You desire to pay for that. Your education goal is to pay for 4 years tuition for each child at $17,000 per year in today's dollars. So the lump sum in today's dollars is $120,418.17. You could save by paying for tuition now so that you can avoid the cost of inflation. So you all have considered a couple options, or 3 options, to do this. The first option is to save for college tuition in a traditional brokerage account, but this option does leave you open to risk and the cost of inflation. The second option is to purchase a traditional 529 savings plan for your children. And the third option is to purchase a prepaid tuition program. So you're considering using that prepaid tuition program to fund the education expenses for the 3 children. I'm going to recommend the 529 plan because of the flexibility that it provides, the inflation protection that it provides. And if your children, or one of your children, or all of your children get a scholarship or decide that they don't want to attend a particular school in the state, the traditional 529 plan will give you that flexibility. It'll also cover many education related expenses, including your books, tuition, equipment fees, room and board. You should open separate accounts for each child because they're close in age, and it can be difficult to transfer from one child to other children. For your retirement savings, you all are considering two different scenarios for retirement, and I'm really glad that you brought this up because it allows me to highlight the major difference between both options. So the first option is to retire at age 62 with 70% wage replacement and no Social Security. So living on 70% of what you make today, not taking into account any of your Social Security. In order to do that, you'll need to save, in addition to what you're saving now from Mr. Griffin's 401k, an additional $17,158.76 per year. So retiring that way means that you'll have less time. You have 25 years to save for 26 years in retirement. And you would need more than $1.1 million to retire at age 62. If you decide to wait and retire at 65 with 80% wage replacement, meaning that you have more of your pre-retirement income to live off of, also including Social Security, meaning that you only have to allocate less of your wages now towards your retirement, you actually come out, you fare a lot better. You would only have to save an additional $4,052.25 each year to meet that retirement goal. And your retirement, the future value at age 62 is 1.1 million. 1.1 million. So same thing, a much different amount to save. So let's briefly discuss your taxes. So I did prepare a tax document for you all, just going over how much you all are making, your adjusted gross income. So your total income for the year was $85,000. Your adjusted gross income was $79,118. You all were able to take $19,750 in personal and dependency exemptions. Your total itemized deductions were $21,778, leaving you with a tax liability of $3,638. But your withholding was $15,000. So you all will receive a refund of $11,361.50, giving you an excellent jump start to your savings. But I would recommend that you all consider adjusting your withholding. You all would fare better having that cash to save on a regular basis rather than waiting to receive it back from the IRS each year. Thank you for filling out information on your risk tolerance. You all scored a 19, indicating that you have a moderate tolerance for risk and that your investment portfolio can be somewhat aggressively allocated. Both your retirement and education goals have a long-term time horizon because you have more than 7 years to achieve them. So based on your score and time horizon, your portfolio should be allocated in the RT4 target in the long-term horizon for retirement and education. Proper asset allocation will help you all meet your investment goals while only taking on the risk that you feel comfortable with. I also would like to go over just a high level, some of the estate planning things that I would like to see you all adding to your portfolio. The very first thing would be to create a will. I feel that both of you should have a will, and there are a few important provisions that I think that you should include. The first is a survival clause that makes sure that beneficiaries only receive the bequest if they survive the decedent. Secondly, a simultaneous death clause. It makes sure that the spouse with the smaller estate is the survivor, which reduces federal estate taxes in the event that both of you die simultaneously. You all should appoint an executor of the estate and a guardian. Executor would perform your final duties at your time of death, including paying your final debts, filing your taxes, finding your beneficiaries, and very important things. The guardian would provide care for your minor children or your elderly parents if that's needed. You all should establish an advanced medical directive. It lays out who will make all the important healthcare decisions if an individual is unable to do so. You should also properly title your assets in order to avoid probate. This includes all of your checking and savings accounts, all of your investments, all assets, property, real property, and this ensures that it transfers smoothly, that assets aren't held up, and that they go to whomever you all would like to see them go to. So I like to recap some of the recommendations that I've made along the way. Of course, my recommendations are gone into depth much further in the actual document that I'm sending over. But just at a high level, we know that you need to increase the life insurance policy for Mr. Griffin. Also, establish a life insurance policy for Mrs. Griffin. We need to slightly increase the disability insurance policy. You all can make adjustments to both of these policies with the help of an insurance professional. Your homeowner's insurance policy should be increased to a limit of $288,000. The dwelling limit should be at least that amount. That's 80% of the market value of your home. You all can make this change with the help of an insurance professional, as well as the increase to your auto policy that we discussed earlier, and establishing the liability insurance policy. Your insurance professional can help you make adjustments to all of these. There are sometimes savings for bundling policies with one carrier, but you may be able to find savings by establishing policies with multiple carriers. So for your debt management and short-term obligations, I'm recommending that you refinance your primary mortgage from your current rate of 6.25 to the rate of 4.0. That's going to give you all a savings of $6,623.52 per year. You would actually make that change with the help of a mortgage banker or a broker. You should also pay off the balance on your credit card debt. This is the highest interest debt that you all have. That is $18,817. So the savings that you all receive from refinancing your home mortgage and the savings, your income tax refund, can be applied towards paying off that high interest debt. For education and education funding, I'm recommending that you all establish a 529 college savings plan for each of your children. You can do this with the help of a financial professional, so I'd be more than happy to help you with that. For your retirement, I would recommend that you take option 2, which is retiring at age 65 with the 80% wage replacement and Social Security. You all would need to save only an additional $4,052.25 to meet this requirement goal, and you can achieve this with the help of a financial professional. For your taxes, I would like for you all to contribute this year's tax refund towards your annual savings and reduce your withholding for next year and save the extra funds. That way you can earn some interest on your money that's being held by the federal government instead of them holding it and earning interest. For your risk tolerance and your investments, I believe that you should keep your current stock. I think that you should establish an investment portfolio that matches the RT4 target for the long-term horizon. You can do this with the help of a financial professional. And for estate planning, you all should establish a will with the simultaneous death clause, appoint an executor and a guardian, establish an advance medical directive, and properly title all of your assets to avoid probate. You can do this with the help of a financial professional and an attorney. I'd like to thank you all very much for taking the time to meet with me today. If you all have any questions for me, please feel free to reach out. I'd be more than happy to help you and go into more detail on any subject that you'd like to dive into. Please reply to me when you receive this information. I'd like to know what you think about the analysis and the recommendations. I look forward to speaking with you. Thanks.